And now we move on to our next session, which is equity, what lies in the future. For that, we have none other than Mr. Nilesh Shah. Nilesh Bhai has been a stalwart of the field, and over to you, Nilesh Bhai. Your thoughts on equities and what lies ahead. You're on mute, Nilesh Bhai. You will have to unmute yourself.
Thank you, Alok Bhai. Very good afternoon to everyone. Clearly, from the lows of March, we have bounced significantly. It has created a lot of skeptics among investors whether markets have run up ahead of fundamentals. Many people have booked profit and now are praying for correction so that they can enter at lower level. Let me just point out few scenarios. I have no idea where markets will go in the near term, but I am certain that in the longer term, markets are headed higher. The first and foremost is the flows. On 5th November, Honorable Prime Minister interacted with global investors, and whether his magic worked or something else. But thereafter, every day, FPIs have bought virtually what they were buying previous year on a monthly basis. There are 4 to 5 days left in the month of November, and already this is the highest ever monthly investment by FPIs in excess of 45,000 crore. My feeling is that in the month of November, FPIs will invest more money than what they invested in whole of last year. And before that, it was negative. So effectively, we are looking at 2 years flow in just 1 month. When money comes like this, obviously prices will get supported. Number two, we believe with MSCI and FTSE reaching, FPIs will continue to remain bullish on India. With upheavals in US, there is reasonably good chance that people will remain bullish emerging market, and to that extent, India will benefit. If I have to take a call over next 5 years, I think FPIs will be buyers rather than sellers in market like India. Number two, retail investors this time has surprised everyone. They started buying right at the lows of the market, and they have continued to load it up. Whether it's direct equity or whether it's SIP via mutual fund, the retail investors have the last laugh as they have invested at the bottom. Unfortunately, in my interaction with HNIs, they have booked profit, they have encashed themselves out, and there is reasonable amount of waiting cash to be invested in the market. The experience suggests that generally waiting cash is sucked in and then only correction comes. Be the case as it may be, retail and FPIs this time has been a buyer and HNIs have been seller. From the mutual fund point of view, last 3-4 months we have been net seller, but it is not a view on the market. We are not increasing cash balance. It's just that some of the investors led by EPFO and HNIs have redeemed, which in turn has pushed fund managers to sell. The second important thing apart from fund flow is fundamentals. The quarterly results for September have come amazingly ahead of expectations. Nifty profit growth is 17% year on year. The total profit of 107,000 crore for Nifty 500, Nifty 50 companies is all-time high. It's the highest ever quarterly profit in the history. And this has happened when volumes were down or sales were down 7%. With 7% drop in sales to achieve 17% profit growth, obviously you need to expand margin. And this margin expansion has come by tight cost control, by productivity enhancements, by grabbing market share from unorganized sector. Put all these things together, if going forward this corporate performance continues, then we are looking at market which is trading at 23, 24 times forward earning rather than 30 times forward earning. Corporate profitability has bounced back remarkably in September, not only in large cap, but also in mid and small cap. Lower interest rates, tighter working capital, brutal cost control, grabbing market share from unorganized sector, all these things put together has resulted into all-time high margin. And if this continues, definitely market will get supported. Finally, if we are taking a real long-term call on equity market, it will be all about how economic growth recovers. Clearly, June quarter, when we reported 23.9% drop in GDP, it was one of the worst ever drop in GDP in our history. September quarter, the expectation is negative GDP growth, but hopefully higher single-digit GDP growth rather than double-digit. December quarter, lower single-digit drop in GDP growth, and March 21, we should expect positive GDP growth. We don't have control over near term. A lot will depend upon how second wave of infection comes. When will medical solution arrives in terms of preventive vaccine or in terms of drugs which can help cure this disease. But the real long-term economic growth will be dependent upon one factor. In 1980, India and China were of similar size. Over the years, China became manufacturer to the world by attracting foreign direct investment, by bringing manufacturing companies all over the world, becoming export powerhouse, and they did many things right. We did well to become back office to the world, but we lost out on the manufacturing game. Now, world is suspicious of China. Many companies are looking to diversify their supply base out of China. We have seen some successes in sectors like chemicals, in electronics like mobile handsets, but we need to do many more things to ensure that this becomes a big theme. If we can become part of global supply chain by attracting companies out of China to set up their manufacturing base in India, that will change India's growth orbit forever. Let me give you an example. Samsung is a giant Korean company. It came to India long before it went to Vietnam. It makes in India and sells in India mobile handsets, consumer electronics. Being an unlisted company, we don't have access to their data, but roughly their turnover will be about $12 billion in India. Vietnam is 1/10 the size of India. Samsung last year recorded turnover of $62 billion in Vietnam, roughly about 5 times more in an economy which is 1/10 the size of India. Samsung makes in Vietnam and sells all over the world. They contribute 28% of GDP to Vietnam. Vietnam, after recovering from a devastating war, has now higher per capita than India, courtesy companies like Samsung, which contribute substantially to GDP. This is the kind of opportunity which India has. The way we became back office to the world, if we copy the same model and become manufacturer to the world by attracting companies from China to India and by becoming part of global supply chain management, our growth changes forever, and that in turn will support equity market for a long period of time. Undoubtedly, there will be volatility ahead. Markets are markets, they will go up and down. But today, flows from retail and FPIs, quarterly results from corporate India, and potential opportunity of becoming manufacturer to the world, all are supportive of market which will be rising. The only caveat here is that we are not out of wood. We still have second wave of infection. What's happening in Delhi and couple of other places should not happen to rest of India. What's happening in Europe and US should not happen to rest of India. That will allow normal economic activity to continue. That will ensure month-on-month growth of economic activity. And that will be the most important thing for market to continue to rise going forward.
Uh, Nilesh bhai, while we're on the subject, there's a lot of investors who feel that the current indices do not reflect the ground reality. There is a big chasm that, while the lockdown has just kind of got over, people are getting back on their feet, businesses are trying to get back on their feet. So, and markets are at an all time high. Of course, you said led by foreign money, but how does the Indian investor reconcile with the fact that, markets are at an all time high? Ground reality is something very different. Should she be a buyer?
So look, if you remember early 90s liberalization, if you had gone to meet old Seths who were operating in textile mills, who were operating in various industry, they were all saying that this liberalization and reduction in import duty will ensure that our business will die, the whole country will go down the drain. On the other hand, if you had gone to meet new business managers, they were in IT industry, they were in pharma industry, they were in telecom industry, and you talk to them, they said this liberalization is greatest thing that has ever happened to India. And we are going to see new India, we will see tremendous opportunity. In reality, both of them were telling us the truth. But inefficient companies die. There were many companies in Sensex in the early 90s which today don't even exist. On the other hand, IT industry created tremendous wealth for investors. So did pharma, so did telecom. So even like liberalization, in this COVID-19 era, there will be companies which will benefit and there will be companies which will suffer. The economic data is talking about the past. Market is talking about the future. Today, market has priced in that retail and FPI flows will continue. HNIs who are sitting on corner will eventually jump in. So flows will be higher than the supply of paper. Market is also discounting that the second wave of infection will not hit India as hard as it is hitting European nations and America. Third, market is also discounting that the September quarterly results trend will continue, margins will continue. If on a sales degrowth we can generate 17% profit, what will happen when the sales growth will turn positive? Now, whether this assumptions comes true or not, whether they come 1 quarter early, 1 quarter late, that will create market volatility. But if you are buying companies which are taking advantage of this COVID-19 by becoming adaptive, by using digital ecosystem to do business, by cutting costs, by grabbing market share from other players, I think these companies will make money.
Right. Another thing that comes to mind is you mentioned how 28% of GDP of Vietnam is led by companies of Samsung, and there are other tigers like Indonesia, Malaysia, Korea, Sri Lanka, Bangladesh. Bangladesh has been doing ever so well. So this opportunity was always there for us, and we've not been able to capitalize on it. What is it this time around, which is different, that has you believe that we'll be able to capitalize on this opportunity? Or the other part of the question is, are we sending conflicting signals to the world when we say we want to be an Atmanirbhar Bharat? So are foreign manufacturers getting cagey, or are we sending conflicting signals? Your take.
So one, look, there are two models for development in India. One I will call Singur model, other I will call Sanand model. In Singur, Tata's, India's most respected business house, went to set up an automobile plant, struggled forever, and finally they had to move out. In Sanand, they came on one SMS, Suswagatam or welcome, In 18 months, they started rolling out cars from their factory. Land was allotted, approvals were given, construction was facilitated, additional roads, other infrastructure was built, and in 18 months, the factory started rolling the car. If whole of India follows Sanand model, we will be able to attract foreign direct investments from outside the world. If we decide to adopt Sanand model, there will be disaster. Now, obviously, if we see current thinking across political lines, across central and state, I think by and large everyone wants to follow Sanand model. We have already seen stunning success where Samsung shifted their entire mobile handsets plants from China to India, where a German footwear company shifted their entire footwear company to Agra. So there is one mindset change compared to earlier period where people are focused on bringing foreign direct investment in manufacturing to India. Have we reached nirvana over there? Answer is no. We still have to keep on improving and keep on working. But I think directionally we are right. The second thing is related to, Atmanirbhar Bharat. Lots of probably wrong notion is being spread on Atmanirbhar Bharat. Atmanirbhar Bharat doesn't mean isolated India. It means connected India doing trade with the world on its terms. Now imagine we have 1.36 billion consumers. By becoming Atmanirbhar Bharat, I am giving access to this 1.36 billion consumer market which no other country other than China can provide. All the countries of Korea, Vietnam, Thailand, Indonesia, Philippines, Taiwan put together does not have 1.36 billion consumer. Now imagine I go to a consumer electronics company and say that you come and set up your shop in India. I'll give you preferential access to 1.36 billion consumer market, but ensure that you also export out of India. Make India part of your global supply base. I think any company will be willing to buy for it. So you achieve Atmanirbhar Bharat, which doesn't have to import consumer electronics, which imports some components, but eventually we export far more than that. I think what we did with Maruti Suzuki is what we have to do with every other thing. We were the first Asian country to manufacture automobiles. But till 1980s, before the entry of Maruti Suzuki, we were not a powerhouse in automobile. Today, automobile contributes more than 40% of India's manufacturing GDP. It's the only manufacturing item of size where we have export surplus. We have $14 billion surplus. And you go to any continent, you will find Indian automobile product. Our motorcycles, our cars manufactured in India, it's roaming in all the continents. What we did with Maruti Suzuki in automobiles, we have to do it across other sectors. And what we did with Maruti is, in essence, Atmanirbhar Bharat.
Fantastic. What do you feel that India is poised, or will India produce something like the next Google or next Facebook? And what will it take for the Indian entrepreneur to be able to do that? And do we have the right ecosystem, or there are some gaps already?
So one is talent. We have to ensure that Satya Nadella and Sundar Pichai operates in India and not in US. Now, they had to go to US for a variety of reasons. How do I ensure that next generation of Satya Nadella and Sundar Pichai remains in India and doesn't go out? Second, it's not that the seed alone should be good enough. The surrounding of the seed also needs to be good enough so that a giant tree can blossom. So we need seeds like Satya Nadella and Sundar Pichai, and we need environment which is supportive so that that seeds can blossom into a company like Google. It's not that we haven't created worthwhile companies. TCS today is a fantastic example of what Indians can create, but it required tremendous struggle. And we have very few companies like TCS with us. What we need is that with support, TCS kind of companies can be created. So we have a lot of work to do, but most important thing is to retain talent in India and encourage entrepreneurship. Today, Alok Bhai, whether we like it or not, but the fact remains that becoming entrepreneur is like Abhimanyu. In the Satyug Mahabharat Yug, Abhimanyu was fighting only with Kauravs. And he was always fighting with the belief that my uncles and relatives are coming to support me. Today, unfortunately, businessman is like Abhimanyu. He's fighting Kauravs, which is the market volatility, demand and supply mismatches, price fluctuation. But the Pandavas are also fighting with Abhimanyu. The excise inspector, the VAT inspector, the GST inspector, the rules, regulations, policies. Unless until we support our Abhimanyu, he doesn't have a chance to break the Chakravyu. We have to encourage entrepreneurship in this country.
Thank you so much, Nilesh Bhai, for those lovely, candid, and heartwarming thoughts. With a hope that we will continue to do well, and the Indian markets are ripe to go places from here, and there is a lot of hope for the Indian investor. I request you to stay on. Our next session is with Ramdevji Agarwal, again somebody who needs no introduction. Ramdevji, if you could switch your video and audio on, please. Ujjwal, can you just check with Team Ramdevji if they can be online?
Yes.
So till the time Ramdevji joins us, Nilesh bhai, I will take this opportunity and engage you a little more. What do you think about the quality of reporting of our companies? We have different kinds of companies, large companies, mid caps, micro caps, and the ocean of investing is open for all investors. But a general comment about the quality of reporting and how much can investors trust the numbers put out by companies?
So look, I don't think so we can paint India with the same brush. There are companies, local companies, which publish fantastic annual reports. They give you so much information that just reading balance sheet is good enough. On the other hand, there are multinational companies which try to hide information. There are local auditors which publish fantastic report. There are global auditors which forgot to figure out that whether fixed deposits were there or not. So each case is different. There's no standard consensus to say that global multinational auditors are great. All multinational companies give great accounting and Indian companies don't. Please take companies based on their track record. ये पूरा मतलब अपने वहां पे range available है. We have the best reportings to worst reportings across the board. There's only one thing, Alok bhai, which I want to say. In US for Satyam, the auditor has already paid a fine to SEC and a class action suit has been settled with investors. For a fraud committed in India, they have paid the penalty in US. But in India, nothing has happened. Satyam shareholders haven't got anything. I think this is where we need to improve. For a fraud committed in India, punishment should have been first in India and then in US.
Absolutely. I think therein lies the key, that there is a gap between intent of regulation and the punishment thereon. Ujjwal, have you gotten through to Team Ramdevji?
On it, Alokji, on it.
Okay. So, if I could ask you, Nilesh bhai, what are there a couple of themes that you have identified for the Indian investor that they can look at progressively going forward?
Alok bhai, there is one all-weather theme where in any sector where public sector has higher market share and private sector enters, over a period of time, private sector will become large player over there. We saw that in mutual fund where public sector mutual funds were 100% of market. Over a period of time, large players emerged from private sector. If we see the same thing in general insurance today, 50% market share is with public insurance companies. Over a period of time, private players will go big over there. The same thing is available in banking services, where private sector with their access to capital and better administrative freedom to do business will gain larger market share. So try to focus on companies which are today having smaller market shares in a sector dominated by public sector. Eventually, they'll become big over there. The second theme is this global supply chain participation. Clearly, in contract manufacturing and in chemicals, we have seen benefits coming to existing players. Like technology, many players will emerge in this sector. Valuations have run up a little bit, but if you take a longer term view, then probably you still have opportunities in sectors which are going to become part of global supply chain management, like chemicals, like contract manufacturing.
Fantastic. Thank you so much for that. I'm still waiting for our team to see if Ramdev ji has come on. So these are the vagaries of technology that we have to deal with. Nonetheless, we keep our chin up and move forward. And I am going to keep drilling Nilesh bhai till the time that Ramdev ji makes an appearance. You know, being in the stockbroking industry for over 2.5, 3 decades, I personally have seen a lot of changes in the landscape. What about regulations? Do you feel our markets are adequately regulated, over-regulated? What's your take from where you're sitting, from your perspective?
So there is a saying, I don't remember it exactly, but it somewhere says like this, कि खुद ही को कर बुलंद इतना कि हर फैसले से पहले खुदा पूछे बता बंदे तेरी मर्जी क्या है. Now this is applicable to us. We should follow practices and code of conduct in a manner where regulator feels obliged to ask us, ki, bhai, I want to do this, are you interested? Now, Alok bhai, we started our career in the frame, in the era where gala was official word. No matter what price you sold, it was always the lowest of the day. And no matter what you bought, it was always highest of the day. There were exceptions in broking community who were honest, but gala was an official word. Vandha, patawat, badla, exchange default, payment crisis, these were all official words. Now, because we couldn't behave ourselves, regulation was necessary. And regulation always will come with heavy hand. First, it will tighten and straight-check errors, omissions. And after, once we establish our behavior, slowly, it will expand. Self-regulation is far better than going through this process. Clearly, we have come a long way from the early 90s and early 80s. Now, all those words like Bandho, Badla, Patawat, payment crisis, company circle buying are bad words and out of our dictionary. So look, bhai, if we do self-regulation, regulators will be more than happy to support us. It's not that regulators are not aware, but when you misbehave, there has to be straight-jacketing and then relaxation. But with self-regulation, we will be able to start with relaxed regulatory environment.
Nilesh bhai, I know you're an avid reader. Are there any nice books that you could suggest our young investors that they could cut their teeth with whilst beginning their investing career?
Alok bhai, just keep on reading whatever you get. I mean, when I was young, my parents taught me to read Mahabharata and Ramayana, and I was always wondering कि ये सब पढ़ के क्या होगा. Today, I think I get far more learning from Mahabharata and Ramayana on stock market and human behavior than from books written by various, authorities. So just keep on reading. I think Ramdev ji also has been an avid reader. If I'm not mistaken, he'll be probably reading one book a week or even more. तो ज्ञान का सागर है, उसमें जितना मिले ले लेना चाहिए. Don't focus on buckets. There is an ocean out there. Keep on absorbing whatever you can absorb.
Thank you so much. I think Ramdev ji is back with us. Can we have the audio and video on for Ramdev ji, please?
There has been some technical issues, Alok ji. We are just trying for the same.
Okay. Cool. Nilesh bhai, while the technical issues are being sorted, we will seek your indulgence to keep our investors who are logged on online with us occupied and engaged, and share from the wealth of your knowledge that what are the don'ts that a young investor should keep in mind while investing.
So one, if any investor, young or old, reads balance sheet, reads annual report, it gives him tremendous advantage over other investors. I have seen sell-side analysts also who haven't read balance sheet. And when I say read balance sheet, that means you have to analyze and understand it. Reading is not just plain reading. Reading is all about absorption. When I go to meet some legendary investors, they simplify the business model of a company in few points. Now that simplification comes because they have absorbed the entire annual report, the entire business model. Numbers come on their fingertip. We can't be as good as them, but certainly reading annual report and analyzing annual report is the starting point. Second, when you are investing, find out what are you doing. Is it a short-term investment, medium-term investment, long-term investment? Is it trading? If you are a trader, then stop loss is critical. If you are an investor, then averaging is critical. The biggest mistake which people make is that in investment, they put stop loss, and in trading, they do averaging, and eventually it doesn't work. The third thing about investment is picking up bigger trends. For example, when multiplexes came, it was visible to everyone that now Dabba theaters will move to multiplexes, and eventually people will go out to multiplexes. Now this was one big trend which you could have captured. Similarly, when private sector banks came and they started providing better services to PSU Bank, it was no-brainer how private sector banks will outperform public sector banks. It was 2 decades, 3 decades growth story. One could have participated in this big trends. Today, global supply chain disruption is a theme which is visible to everyone. Now we just have to identify right promoter and right company in this space, and it will create a decade plus opportunity. So look at the long-term trend, decide whether you're investing or trading, and finally read the annual report of the company and understand it so that you can stay on that long-term trend.
Perfect, sir. So I believe the team is, because there is some technical issue, and the team is trying to get Ramdev ji on a telephone line now. I think Nilesh bhai, we've taken a lot of your time, so we can let you go now. Thank you so much for having enlightened our investors out there about various facets and a rounded 360-degree discussion. Thank you once again.